Hi, Dan Kerr's DK Analytics. It is February 28th, 2017. Thanks a lot for tuning in. We'd like to follow up as an addendum to our video of last week, more than a month later, after the beginning of the Trump administration, to drill down just a little bit in facts and figures regarding precious metals, to help frame the importance of these assets of real money as a diversifier, as portfolio insurance, and if history is any guide, and especially given the super N, a potential levitation of returns or purchasing power that you might derive given all the monetary malfeasance and manipulation that's been going on. Let me revert back to an example to start this off with. As a Credit Suisse CIO office thematic strategist for about 4 years until 2012, I met lots of interesting people. I was based in Zurich, Switzerland. And one of them was a strategist for UBS at the time. He was a former mining engineer, a metallurgical engineer, and he spent 10 years in South African gold mines, managing the manufacturing, the search for gold, the whole engineering side of things. And he made a very interesting observation to me, which I never forgot. And that's this. During 10 years of entering these mines and manufacturing the mining, he never saw in South Africa, one of the leading gold producers, as much as gold flakes, not to mention a gold nugget of any size whatsoever. Why do I say that? To give you just one indication of how rare a gold is. That is an extremely rare, precious metal, and the same goes for silver. About 10 times more prevalent than gold, but still extremely rare, and that's one of the reasons that both of them are, you guessed it, precious metals. Sometimes an example helps frame these things. I'm going to tell you the following as to get your arms around these two precious metals. Real money over time, immortal in essence. How much is mined a year? Well, would it surprise you if I told you that only about $120 billion worth of gold at current prices is mined? That's about 2,800 metric tons a year, about 90 million ounces. If we shift to silver, a tiny 16 billion or so is mined annually at current price levels or about 900 million troy ounces, about 10 times gold's 90 million troy ounces. Contrast this, if you would, we go into this in a couple of posts and reports, with investable global assets of about 300 trillion. And those investable global assets have been going up over the last decade by between 5 and 7 trillion a year. Altogether, only about $140 billion worth of gold and silver are mined, and they supply only 60-70% of global demand. Right? If we think about the fact that the allocation of that 300 trillion of global investable assets, about 70 to 74% bonds, the vast majority, and 20 to 24% stocks, and the rest being other things. Well, one of those other things is precious metals. And precious metals only accounts for 0.5%. It was once up to 1.5% in the 70s, by the way, in the stagflationary 70s. But precious metals, led by gold, to a lesser degree silver, only account for roughly 0.5% or $1.5 trillion of the globe's investable financial assets, roughly 300 trillion. Now, think about this. Silver comes out of the ground about 10 to 1 a gold. We mentioned 900 troy ounces of silver to about 90 troy ounces of gold manufactured. And they're both heading south because it's not profitable at these manipulated levels, and it's harder and harder to get, which is one of the reasons we strongly suggest that investors don't purchase a priori gold or silver mines, but really get the physical, because otherwise you're going into mining risks that they are huge, spelled with a capital H. If we take a look at the value of gold to silver, the gold to silver ratio is 70 to 1. Yet they're mined 10 to 1. That is 10 ounces of silver to 1 ounce of gold. Yet 1 ounce of gold is worth 70 ounces of silver. Silver's been demonetized for a host of reasons we won't get into here, but it is in essence trading for, the 70th of gold, and it should be trading at a 10th of gold, especially if silver's monetary aspects will come back into being also in the West. They're already, they still exist much to the East. And especially as silver has a host of huge and growing industrial applications. Which brings me to another point. The above ground supply of gold, and there are lots of figures bandied about. It's very difficult, and a lot of them are I'm going to say devious or less than forthright. But let's say there's roughly $7 trillion worth of gold, above ground gold, right, which is about 3/4 of the estimated gold supply. Silver, on the other hand, there's not much silver that's above ground that's worth anybody's while to get, because the majority of silver has been used in for industrial purposes, especially electronics. If you think of your iPhones, your computers, your tablets, a lot of these gadgets and other gadgets that contain sparse or slight amounts of silver dot global landfills, garbage dumps. But there are very minute amounts of silver in each of these devices or these tools or these gadgets. So it doesn't make any sense to try to get them back into a usable format. It's difficult to reclaim, in other words, or to recycle is the word I'm looking for. So for all intents and purposes, there's very little above ground silver that's usable, refinable, or can be brought back into use for the public that makes any kind of economic sense, given how scattered it is in landfills and very small quantities in devices. Now, let's say, for example, that the global investors' confidence, and this is really a confidence game, right? Because if you have fiat governments that rule the law pretty much around the world, you have fiat money, the kissing cousin of fiat government, and you still have confidence in the value of fiat currency, the various fiat currencies that we have, the euro, the dollar, the yen, and the whole bevy of other currencies that we have. They are all no longer tethered to physical gold and silver. And as a result, we have money printing and debt mountains. The two are hooked, they're linked, right? They're hand in glove. So what happens if all of a sudden people get afraid of the increasing indebtedness the world has? I mentioned this in recent posts, but let's do the numbers just for a second. We'll recap them. There's approximately $217 trillion of interest-bearing debt globally, up from $87 trillion about 16 years ago. Our debt to GDP ratio, the leverage we have, how indebted our global economy is roughly 3 to 1. Global GDP is about 75 trillion. Our global interest-bearing debt is about 217 trillion. That's where we get all that 300 trillion odd of global investable assets. That's that biggest chunk is, yes, bonds issued and those becoming more valuable thanks to financial repression, artificially low interest rates, and QE, money printing, right? Or the put or the threat of supporting asset prices, be it bonds or stocks, pushes them above their issue value, right? What happens if people lose trust? And we mentioned black swans. I mean, obviously you can't forever continue to sustain higher debt than GDP growth without risking solvency, with all the money printing, without risking monetary inflation. And when one superimposes all this, as said, on dwindling and actually now shrinking global economy, it is one heck of a mess. And confidence is very fragile. It can evaporate overnight. What happens if it does? And we don't know what the trigger is going to be, but sure enough, it's going to happen. Sure as night follows day. Well, then investors, maybe led by bond vigilantes, will look to shift a portion of their assets into physical precious metals. Now, their charter forces them to invest in financial assets. So they might have to do it via gold and silver backed ETFs, but there's going to be a big push into gold and silver. The East has already been going there, and the West is also going to head in that direction. But now what happens if they run into the reality that there is really no usable above ground silver, and physical gold is in the hands of strong Eastern accounts? They're not going to let go of it. How are they going to get it? Well, through mining. Well, but what if we only mine at today's prices of gold and silver in dollar terms, about 140 billion a year? What happens if the global investors want to up their ante from 0.5% of 300 trillion, give or take, of global investable assets to say 1%, right? That's not that big. Well, going from 0.5% exposure, or roughly 1.5 trillion in precious metals, to 1% would mean another $1.5 trillion. That's the equivalent of over 10 years of physical or of gold and silver mining at current production rates, which are heading south due to increasing geological difficulties in extracting it from the ground in the first place. So what's our point? Our point is that the only way this is going to happen is if the equilibrium price of gold and silver vault much, much higher. And that vaulting much, much higher will likely drive gold much closer to historical parity. Will drive the silver price much closer to the historical parity of 10 to 1 with gold. The way you mine it, you get 10 times as much silver as you do gold, not 70 to 1. So we're looking for both physical gold and physical silver, or let's just call it the dollar price of gold and silver, to vault higher when there is just a minimal reallocation towards these assets, when confidence crumbles in fiat money and fiat government. Now, let me mention confidence. Confidence is that the central bank and the hedge funds and everybody else and people doing momentum trading and what have you, they're playing the central bank's behavior, that they will continue to uphold, support asset prices, bonds, and yes, to a large or increasing degree also stocks. So they're banking on central bank puts. I mentioned the extraction of gold and silver being 140 trillion. Heck, the Euro and the Bank of Japan print the annual output of gold and silver in about a month, right? And I think the Fed's going to rejoin the party. But what happens if central banks get overwhelmed by people heading for the hills and no longer believing this toxic public policy stew that I mentioned, but more than that, the extreme asset valuations of bonds and stocks, which offer investors no viable protection of capital, no inflation protection. So we've got solvency risk, we've got inflation risks, and we don't earn a real yield, heaven knows. So this could easily morph and push people at the margin even big institutional accounts, into gold and silver exposure. And one can only go one way to get there, and that is via much higher equilibrium price in both gold and especially in silver. Now, let me end this video with one other thought. The past few days there's been quite a bit of discussion about Donald Trump and the GOP, and a lot of this was I think kicked off with a David Stockman interview where he came out and said that Trump means business. Around 15th of March, they're not going to raise the debt limit in the United States. And you know what I think? I think we're going to see business as usual. Do I know that? No, but I think so. And here's why. Donald Trump is much more interested in tweets and sound bites and in grabbing attention and positive news and in nationalism instead of capitalism. And he's interested in driving government spending higher, much more than lower. And you know what? Both the GOP, or the Republicans in name only at this point, and their Democratic brethren will cheer that process on. But nobody wants to take away the punch bowl. And certainly that isn't Donald Trump's focus. It's anything but. It's kind of last in line. As a result, I think the current brouhaha are concerned about all of a sudden the U.S. government becoming adult-like, tending to the store and learning to live within a debt ceiling or drastically cutting spending while they increase it. I think that's a lot of hooey. And I think you do too. All the more reason that the Fed will have to get involved to save us or to give us another drink. And that additional drink or many drinks, combined with the trajectory of the rest of the world, speaks volumes, not only about the undervalued state of gold and silver, but why you should have them as an integral diversifier and as portfolio insurance in your accounts. In fact, they might even bring you to heightened purchasing power down the road if history is any guide. My family in 1973 or 74 took a trip across the country. Here's another piece of a little bit of personal flavor, if you will, and indulge me. We stayed very often at Days Inn, an outfit that at that time it cost $8 a night to stay at a Days Inn hotel. Well, fast forward about 45 years. I just went and looked at the Days Inn in the Northeast, the Southeast, Texas, and California. The average rate is about $70 a night from 8. That spells inflation of about 5% on a per annual basis or an annualized basis. Well, gold has done more than that over the same time period. It is up about 8% and silver about 5.5%. What's my point? Precious metals in eras of fiat money, where central banks have decoupled from the restrictions of above ground gold and silver, they not only protect your purchasing power, but they actually slightly enhance it. And as we're about to double down on insanity, and we have been ever since the '08 crisis, I think the seat at the allocation table of both those metals, and especially silver, for those accounts that can handle a lot of volatility, is more apt than ever. Thanks for tuning in. Hope you found this of interest. Over and out. Bye-bye.